Hello, welcome to the week ahead with me, Chris Pollock. We'll look back on last week, which we've got some big takeaways from, and also look at the first week of the year, price action on stock markets, particularly. This is always quite illustrative, or often very illustrative of what the year has ahead of it. Plus, look back over the last couple of years and what those implications may be for the global stock market for the year ahead. So let's start there with the big picture on this. Let's not forget what last year was for the stock markets. We had an absolutely mammoth year in the S&P, huge appreciations in price, albeit until December, did kind of unwind somewhat into the close of the year. But we had a lovely year in the stock markets, taking most global markets to all-time highs. This follows on from 2023, which was another wonderful year for the stock market. So back to back, we've had two of the best consecutive up years in a row in US stock markets, which all looks lovely until you look at the data, right? Statistically, whenever you've had two moves higher year on year, as big as this, the year that follows typically has one of the lowest win rates and lowest chances of probabilities of a win of anything we see in terms of global stock markets. Let's not forget the nature of these markets. They go up and to the right, don't they? So it takes a brave man to bet on these markets going lower. But when you've had such back-to-back 2 years of appreciation, this might be one of those years where you look down rather than up. The first week of the year itself, you see, or the first proper week, we did have a kind of down it was a tiny bit in the first couple of trading days, but the first full week of the year was very much a down week. We'll have a look more details into why in a moment. There's a few interesting things out there in terms of news and in terms of bond yields leading the kind of headlines on this. But this has kind of taken the S&P down to where we were around the time that Trump was voted in, right? We had that huge week on the news that he was taking over as the new president, and it feels like taking out these lows this week looks almost inevitable to me. And 3 weekly equal lows, I think, will be tested, probably taken. I'm certainly looking short at least this Monday to see what the inflation data has for us later in the week and get more into that in a moment. But looking back at the start of 2024, this was a down first week of the year, but it did reverse rather quickly. So it wasn't illustrative of that year. But if we see 2023, the first proper week of the year was an up year and up week, and we had a nice run in there. But more interestingly, in 2022, we had a pretty ropey start to 2022, and it was a ropey year, right? We had a 30+% decline into the October of 2022. A few smart market commentators suggesting this year might parallel more with what we saw in 2022 than we saw through 23 and 24. So be a little bit less gung-ho on your BTFD strategies on stocks would be my suggestion, given how far we've come. And given something else we saw with the yields last week, this is something that is creeping higher. The higher for longer trade is coming through. There's a lot of fear. We heard from the minutes last week on Wednesday from the meeting that we had on the Fed in December that they are keeping their eye out for inflationary pressures. They believe that, or certainly some of the members are considering that Trump policy, whether it comes to raising tariffs or his hard stance on immigration, these will be potentially quite inflationary. This is meaning that the Fed are probably going to keep their interest rates higher for longer. This was already the case that we saw on Wednesday after the Fed minutes came through, but that was exacerbated by the data that we had on Friday, which we'll look at more specifically now. So back to last week, and what a week it was, right? We had some big positive data, didn't we, on the non-farm payrolls on Friday. We were expecting 164,000 jobs created. We nearly got 100,000 more than that. So really strong numbers into the first payroll figure of the year. This was coupled with the unemployment rate dropping from the expected 4.2% down. Good news, obviously, down to 4.1%. So good news on jobs, on the non-farm payrolls, and on the unemployment rate. That you would expect, certainly last year, would have been good news for the stock market. On Friday, it was not. We had a big decline on the S&P. If we look at where we were from 130 on Friday to where we reside now, we're looking down over 100 points on the S&P. So good news very much being bad news for the stock market. Throughout the last 6 months of last year, strong non-farm payroll figures would have lifted the stock market, but now we're seeing downward action on strong news. This is something we were kind of red flagging on Tuesday because we had a little taste of this with the JOLTS numbers being stronger than expected on Tuesday, the ISM numbers being stronger on Tuesday. And that on Tuesday led to a similar sort of magnitude of decline from 3 o'clock when those figures were released. So good news again was bad news on Tuesday. That's 2 in a row. But what kind of hindered my kind of full conviction on good news being bad news is we had some really strong inflation numbers wrapped up inside that ISM figure. And that to me was maybe a sign that the market was just reacting to the inflation fears in this. But given the non-farm payroll inflation number, the average hourly earnings was flat relative to expectations, bang in line with expectations. This was not an inflation story on Friday. This was a jobs story. Good news, good jobs was very bad for the stock market. So this can give me kind of real confidence going forwards now that if we do get strong jobs data, strong growth data, strong retail sales, we're getting a few of these out this week, that we will probably see the stock markets react negatively to that until we don't, right? But for the meantime, I'm going to be looking short stocks if we get positive news out. Really helped that this variable was held flat. The inflation number was, as I say, in line with expectations. So this was kind of the perfect number for me on Friday. If we could have kept this number completely in line with expectations, but just seen a deviation in the jobs, that would really highlight whether good news was bad news on the jobs front. And that's exactly what we saw. So that gives me confidence going forward into the year that we can lean on good news being bad news going forward. We touched on the yields briefly in the US. They're creeping up with this higher for longer. It's not just in the US, though. Looking closer to home, Rachel Reeves in the UK is under scrutiny. The 10-year yield is pushing up. Well, I say pushing up. It's nearly up to 5% on the 10-year. We haven't seen even these prices since 2008, which tells a story of where we believe the UK's budget currently lies. These tax cuts, or tax increases, should I say, aren't quite meeting with the tax spending. And as Mark Carney voiced in 2017, that he believes we need to rely on the kindness of others, the kindness of our foreign friends in order to loan money to us. But they're only willing to do that for a higher and higher reward over the past couple of months. And Rachel Reeves needs to get hold of this a little bit, although she has kind of put herself in a box by saying she's only really making big fiscal moves at the big major budgets. And that is a long way off from where we are now. So the bond vigilantes are up and running on the UK gilts at the moment. Interesting to see how this plays out. Bank of England will probably have to come in and help a little bit and backstop this somewhat. But yeah, keep an eye on the yields this year, because if we keep seeing these creep higher, then that is going to be a concern. And one of the reasons the UK is in such a problem, right, is, certainly post-Brexit, we already had, effectively tariffs put in by Europe. When we left the EU, there was no free trade with Europe anymore. We put up those walls ourselves. Well done. The other issue is now that Trump's going to put up walls to the US. So two of our major trading partners are now a lot more expensive than they were 10 years ago. So these issues mean that we're going to get perhaps more underlying inflation, fewer rate cuts from the Bank of England this year. Certainly, there's an expectation at this point that we're going to get a lot, or many fewer rate cuts than the market expected, even kind of 3, 4, 5 months ago. Hence, these yields crawling or even running higher at the moment. So monitor these key levels. Probably want to put some alerts on at round figures. I'm going to kind of, I've done this already, but we'll pop one very close to that 5% level on the yields, because if you kind of trigger through these psychological levels, then this can often be a bit of a shakedown for the stock markets. We've got this lined up at least for the US at 5%. Don't forget, this is where the yields peaked back in 2023, and that 5% level being very important for the US 10-year. So we'll watch and see with interest what happens there. We're 1 week away from Trump's inauguration as well, so maybe we'll start to hear his rhetoric kind of dial up this week as we hear exactly how these tariffs are going to land. Is he going to attack China as aggressively as he'd previously been suggesting? I mean, they are a big fellow competitor to play against. Maybe this is why he's targeting a little bit more towards the likes of Mexico and Canada, kind of picking up the low-hanging fruit a little bit. There's not going to be quite as much of a geopolitical risk associated with tariffs on Canada. Can't see there being any real issues there other than for the Canadians themselves, right? And then, not going too much further afield to Greenland and Panama. There are their own issues in Trump with that. So listen to his chat. He's probably going to be a bit more on Truth Social than he has been on Twitter in the past. If those of you who've been trading back in his first term back from 2016, he was kind of posting on Twitter and moving markets. Now he has his own social media platform. So if you don't have a Truth Social account and want to follow Trump, you might hear things more quickly on there than you will on X. That's enough of last week. Let's look for the week ahead. That's what this is about, right? And this week is an inflation week. Inflation data, the first inflation prints of the week are going to be interesting. This Monday tends to be quiet always, the Monday after non-farm. If you ever want to, put a day in your calendar to take off every month from now to the end of the year, this Monday after non-farm payrolls is often quite a nice one. To do, there's very little out. You'll see there's no data out of the UK, the US, Europe today. So there's not anything new to hang your hat on, but maybe continuation from Friday isn't necessarily going to be a big surprise, I would say. We're rolling into Tuesday. On the data front, we have PPIs ahead of CPIs. PPIs normally, 10, 11 times out of the 12 months we get, normally come out after the CPI figures. But when the PPIs come out before the CPIs are out on Wednesday this week, this number becomes more important. It's the first inflation read of the year from the US, and I'm much more interested and will probably trade the PPI figures when they come out before the CPI number. So bear this in mind for tomorrow. Normally kind of scoot over this one, maybe watch it in case it's a big surprise, but not normally the thing that I would be kind of targeting for the day. But I think tomorrow this could be quite important. PPIs ahead of CPIs. Consider that slightly more important than the normal way around. On to Wednesday, the UK is getting its yearly inflation figures out. We're getting the US's inflation year-on-year, month-on-month numbers out at 130. And we've got bond auctions in the UK, right? We talked about this a second ago about the 10-year gilt in the UK being under a lot of pressure. So the auction, the appetite for these bonds, these primary bond market sales are going to be very interesting to see if there's many people willing to pick it up at this level, or if those foreign friends willing to lend us money will want even higher yields than we're currently offering. So 10 o'clock on, or just after 10 o'clock off on Wednesday this week, that will be an interesting one in the UK. You Fed members out Wednesday too. Thursday, retail sales, the jobs number for the week. We've got some manufacturing figures out in the US. Got UK GDP, so some growth numbers closer to home. This comes with a raft of other numbers out at the same time. So Thursdays as well, normally a great day. I feel like there's plenty going to be around for this. We've got the monetary policy minutes from the ECB. These are the equivalent of the Fed minutes, right? So that will be something at 12:30 to watch as well if you're trading euro and bunds, euro stock. It's Friday, a little bit quieter. We've got more UK numbers out, quite a big UK week, right? With the GDP, inflation, and retail sales all out at different days at 7 o'clock this week, UK time. Not much in the US, though. Building permits, housing starts don't matter too much. But I kind of feel like all data will be important at the start of the year. And then by Friday, we'll be very much looking forward to looking at Trump's inauguration on Monday. Markets may already be kind of skipping past all this and reacting to what Trump has said throughout the week. But the most important thing for this week for me is not in this data. It is in this data. The earnings are back, right? Earnings create some really interesting trades. My favorite month of the year is when all these, of the quarter, should I say, is when all these earnings come through. And Wednesday is when the first big ones drop. We've got JP Morgan, which often can be a many hundred tick move on the Dow Jones. But this is coupled, what's this? 35 minutes later, so this is 6:55 a.m. Eastern time. This is 11:55 UK. Goldman Sachs out at 7:30 Eastern time US. That's 12:30 UK. These both are often a little bit loose with the time that they deliver this, by the way. So don't be surprised if this comes out 10 minutes earlier or 15 minutes later. Just be aware to watch this. If you want to learn how to do this, please reach out to me, because there's very easy and specific ways you can trade these numbers. The Goldman Sachs is now the biggest component of the Dow Jones, right? Goldman Sachs is now 8.3%. So these large companies within a single index, if their earnings, let's say Goldman Sachs' stock rallies 10% on these figures, well, the Dow Jones will rally 0.835%. That's going to be north of 300 points. And that's at a time when the market isn't even open. This is the time of year, the time of the quarter, more accurately, when you get these sort of moves. So bear that in mind. Doesn't just stop on Wednesday. On Thursday, United Health Group, the second biggest company in the index. This has been in the news for the recent assassination of their CEO. And in fact, has dropped from top spot since then. But it's still a huge chunk of the Dow Jones. Those earnings are out on on Thursday, I believe, of this week. Go to the earnings calendar. Thursday, we have the United Health Group out at 10:55 UK time. Again, this I expect minimum 300-point rally or range in a sell-off too, of course, in the Dow Jones based on these numbers. We also have the Taiwan Semiconductor Manufacturing Company. It might be a good shining a light on the tech sector as we roll through those bigger earnings, the likes of Apple, Microsoft, Nvidia, etc. Well, Nvidia is always very late in the cycle, but Apple, Microsoft, Google, Meta, all these guys will be out in a week or two's time. But for now, we'll start with the Dow Jones components and the United Health Group and the big banks, Goldman Sachs, JP Morgan. And I think will dominate things in the Dow Jones this week. So trade them with interest. But yeah, big week. We've also heard already that there's potential talks of ceasefires and truces with Israel having sending diplomats to Qatar to try and finalize. There's a little bit more, a few more different sources kind of speaking more optimistically about this. Even JD Vance, the future vice president, is suggesting that we may even have something penned before the end of this week, before Trump is inaugurated. So maybe watch that if you are looking at trading your commodities, your golds, your oils. Could be volatile this week based on the geopolitics. That should be a good rundown for the week. Planning the year ahead could be more slightly more nuanced than the up and to the right charts that we've seen for the past couple of years in stocks. Keep an eye on these yields. I think the bond markets, if you want to trade those, could be really fascinating. The earnings are out this week. Inflation data, like the PPI, more interesting than normal, and Trump around the corner. So the year is starting very nicely.